So I suppose first off we can start with Cam. So Cam, why is property a good investment in 2022?
Yeah, great question actually. So two things that are very useful for us, and some of you are aware of this, but sometimes just need that clarity. Two things. One is taxes. So there are so many tax advantages that we've got in property. In fact, at Premier we've got 11 different types of tax advantages that you can use. Tax actually becomes a choice to the fact that you want to pay tax. And of course we should pay tax, and you should pay tax of course according to HMRC's guidelines. But we can make that a choice. And the second one is finance. Finance, property is a great vehicle where you can leverage wisely and correctly and really do much more than you would normally do in any other business. That's my point of view.
Yeah, look, I have to agree with that. I think the main thing that separates property from other types of investments is leverage. You know, the fact that you can take 50 grand and buy a £200,000 property means that by achieving pretty average returns on the asset value, being the property itself, you can get really good returns on your cash. You know, generally we're achieving somewhere between 5 to 10% net cash flow on our cash. And then if you add to that capital growth, which, you know, UK average is about 5% per annum, that's another 20%. So, you know, 25 to 30% returns fairly consistently every year on the cash you're investing, which, you know, I'm yet to hear a logical argument that says that's a bad return. It's pretty good. Any comments on that, guys?
No, just reiterating what you said, really. You know, and it's always there. It's an asset that you hold. You know, it's not going anywhere. You've got access to it all the time. And a buy-to-let investor, you know, there's no shortfall of people needing new homes in this country, as we know. With, you know, we need new homes. It's as simple as that. Josh, any comment from
the so obviously I come at it from a slightly different angle, from the kind of crypto side of things. So I'm slightly more interested in digital assets. Obviously there's very different advantages than property, which I'm sure we'll kind of discuss as we go through the day. But in terms of what the guys have said thus far, of kind of the multiplication of the money, that certainly is one thing that you're not quite able to get in traditional finance products in the crypto space, but there are some secondary advantages that I'm sure we'll get into moving forward.
Can everybody hear us? Because I'm certainly struggling to hear.
Yeah, the sound's a bit wavy, I think.
Sound needs to be fixed, mate. Is that better?
Yeah.
Great. Okay, excellent. Sorry, do you mind just repeating what you said there, Josh? Because I didn't hear,
Paul.
I'm sure therefore most other people didn't.
Yeah, so obviously I come from a slightly different kettle of fish. I'm in the digital assets with the cryptocurrency side of things. Obviously some of you may be aware of how that's, you know, rapidly accelerating into various different markets. So my company, based in Manchester, we actually sell physical computers. So we do offer tangible, you know, secondary to what people think, there are actually tangible ways that you can enter the crypto space with physical bits of equipment. So again, the advantages are slightly different than obviously the mechanisms people will be discussing today, but there are some interesting similarities, and often what we like to do is pair our products with property developers and interests, so you can actually squeeze extra yield out of the same investments or similar footprints. So no doubt we'll be able to hear a bit more about that as we go on.
Yeah, look, certainly in our experience, we've dealt with a lot of people that have made a lot of money from crypto over the past few years and have taken some of that money out and are now building a property portfolio, which I think is pretty sensible, you know, diversifying things. Or perhaps people who are investing in property and have some funds left over and are putting that into crypto because, you know, generally the returns are a lot better than money sitting in the bank.
Yep.
So yeah, not a bad thing to mix. All right, so next question for Reece. What's your outlook on the property market in 2022?
It's a good question. Again, I mean, the property market has been buoyant and prices have risen pretty high. I think that the market will level out to a degree. There's some great areas. What we target and what I speak about a lot is up north. The rental return up there is very buoyant. The yield, you don't get the same, the capital growth, you don't get the same capital growth as you do in some of the bigger cities. We work with like smaller cities, second tier, third tier cities up the north, but we get a great yield on the opportunities. So that's where we see, and I see a lot of growth at the moment for people that are looking to get in the property market if you're looking for buy-to-lets.
Any other comments, guys?
I mean, I'd say the key is what you're looking for. Right now, there's a lot of problems. Do you agree, team out there? Yeah, there's a lot of challenges. There's problems the economy's having. There's a lot of negativity out there. However, as entrepreneurs, as business people, as people in property, one of the things that we do is that we solve problems. The way we do this at Premier, and you can do, I'm sure you're doing it as well, is solving a problem. When you solve a problem, you have an honest business. And from that honest business, you make money. Is that a fair trade, by the way? Yeah, when you think about it. I don't think these things are simple, but they're not simplistic. So treat it like a business. So how does this apply to you in 2022? Well, we've got 5 specific areas as investors, developers. And one of those areas are large cities like London. So London right now, there are a lot of commercial units that are becoming up available, which are entry, secondary parades, tertiary parades, satellite towns around large cities like London. You also find secondary parades and tertiary parades, good honest businesses that have gone out of business, which aren't around anymore because of the pandemic. You can choose to bring them back into order. That's what we're doing. So whether you want to help people or whether you want to make money, it doesn't matter. You can't do both in property. Yeah, it's simple as that. So specifically, commercials in London and the satellite towns, we're focusing on commercial properties, commercials with uppers, where you can actually do strategies like commercial buy-to-let. Satellite towns where HMOs still work, where your capital expenditure is actually minimized. You've got to think about your capital expenditure, minimize that. That works in satellite towns. Buy-to-lets north of Watford are working like a treat. So we get we start from a minimum 7% yield. We've got yields from anywhere between 7% and 12% plus. And you can find these properties. So cost effective, minimum capital expenditure, real golden gems. So what you're doing is in the private equity sector, we're providing a solution for many challenges that are out there. And 2022 really is a year when you can really dig deep and really take hold of those opportunities out here.
Yeah. Look, I tend to agree. I think there's a bit of uncertainty in the market at the moment from external factors, things like Ukraine and all the rest. But I do think that creates opportunity. We had the pandemic, which hopefully is gone and behind us now. That created a lot of pent-up demand, and the market was bouncing back quite strongly once that started to sort of move on. Now, we've obviously been hit with some more uncertainty, but I don't think that's necessarily a bad thing. I think once that's resolved, then we'll have more pent-up demand returning to the market again. I also don't think there's necessarily a bad time to invest in property. It's not about, a quote which I'm sure I stole from someone at some point, but I've kind of claimed it as my own, is that property investment isn't about timing the market. It's about time in the market. So, if you've got spare resources sitting there that could be invested, you're much better off investing it today than trying to pick the market. Because, none of us can pick the market. No one knows what's going to happen tomorrow, next month, 6 months, 12 months. So you're much better off just investing in good properties in good areas with strong fundamentals for the mid to long term, and that's much more likely to perform well for you than holding off until, there's a better time to invest. Because there's always going to be a reason for uncertainty. There's the moment that it's the war in Ukraine. Next it'll be Easter, then it'll be Christmas. There's always a reason why maybe you shouldn't. But I think you're better off getting into the market than holding off, in my opinion.
Yeah, just to add on that, it's about your time and what you're actually looking for yourself. But more importantly, when you are looking to get into it, make sure that you do your research and you know what you're getting involved with before you do. There's a lot of people out there that can help you find what you're looking for, but just make sure it is what you're looking for and not what they're just telling you to look for. That's the best bit of advice I could give, is make sure you do your own research over and over again. And there's never a silly question. Always ask the questions and find out exactly what it is that you're thinking about, and make sure you get them answered before you do just jump into something. But there's loads of opportunity, especially in the times that we're in.
Yeah, I agree. I think the unfortunate thing with the property industry is that it tends to be very sales focused. The traditional way of buying property is you speak with an estate agent who are usually very focused on a particular location, and have a limited, very much a finite list of properties they can sell you. So, my advice would be to speak to someone who's independent, who can actually source something specific to your needs, rather than just what they're trying to sell.
Yeah.
So the fact is, if I may just add in, if it's okay.
Yeah.
So the fact is that people right now with money in the bank have a big problem right now, don't they? Bank of England, I get invited to the monetary debrief at Bank of England. A couple of things happen when I go there. First is, how did the naughty kid from East London get here? And the second thing is, I'm listening to what Rob is really saying under the radar of what's actually being shared. And right now we know that people with money, the inflation is not 5%, it's not 7%. You only got to fill up your car with diesel and petrol. You only got to go look at your utility bills. They've doubled, haven't they? And they're going to quadruple. Yeah. The war in Ukraine, very unfortunate. All of that is adding to inflation. Hopefully you agree, right? So people with money in the bank have a big problem. Now I come from a poor background, very honest background, but a poor background. And my mom, she used to always be on about saving, saving, saving. Poor people, working class people save. Wealthy people, as I've learned to become wealthy, is that they don't save. Wealthy people invest. Now when you think about it, we're discussing property here, and as Paul just mentioned earlier on, loan to value, 75% and so on. You can leverage 75%, still be de-risked, and still be safe. By the way, I'm applying all of this what I'm sharing with you. And that money that you're borrowing from a lender, which is helping you to invest right now, what is actually happening to that money? What is inflation doing to it? That's a question. Are we okay to have a conversation? It's eating it away. It's reducing, isn't it? So are we saying, rather than saving, of course you should have a contingency, a balanced plan, but if you're able to invest like us, you jump into property, you borrow the money on a loan, you learn how to upskill, you upskill yourself so you do it properly as a business, and you use that loan to create income producing assets where the loan in itself is actually diminishing. One thing that inflation is doing for you is reducing that by, my view, over 20% is where inflation is right now. As a developer, any developers in the room? Yeah, you know, to buy a steel, that's gone up by 100%. Inflation is not 5%.
Yeah, I think that inflation's one of the misconceptions when it comes to property, that it's a bad thing, and that just because cost of borrowing is likely to go up, but actually in inflationary markets, property tends to do really well. And as Cam quite rightly said, it's eating away at the cost of the value of your debt. So actually inflation is quite good for people with high levels of debt. It increases your wealth. It's very bad for people with high levels of cash. So taking that cash, putting it into an appreciating asset that generates an income that supports that debt, keeping in mind that obviously you need to be investing in properties that are generating enough income to support not just today's cost of debt, but next year's cost of debt, which is likely to be higher than it is today. But you need to account for that in your cash flows. I suppose that's why it's becoming increasingly difficult to invest in buy-to-let in London and the southeast, because the yields are very limited.
Yep.
And quite often you're able to borrow less and you're kind of just breaking even. That's a bit of a concern, because if the cost of debt increases, that could put you into a negative cash flow position. So certainly my guidance would be that investing in anything today, you want to make sure you've got a decent buffer of cash flow after costs to account for if that cost of borrowing does increase.
And I mean, on kind of my side on the crypto thing, I mean, that's kind of one of the interesting advantages that we have in the digital sphere. So obviously, if you're wanting to build a portfolio and you live in London, some people are less interested in having houses in the north, in Manchester, say, where I'm from. So ultimately, when you have, I mean, in my world, in the digital space, obviously digital assets can remain any and all places all over the world. And when it comes to percentage yields, I mean, obviously for those of you that have followed the crypto market, obviously Bitcoin is, as of today, the highest yielding asset on planet Earth of all time over the past 10 years. So there's an awful lot of growth in those spaces, and ultimately, the machines that we sell mine those coins. So when we're working with property developers that might want to, if you wanted to convert, say, a warehouse in London you might rent that out for a commercial let and get 12, 15% yield. Well, stick some machines in the corner, plug them in, turn them on, and now you're cash flowing 60, 70, 80, 90%. The numbers can really spiral. So ultimately, there's really interesting ways that you can mechanize those two technologies together to increase yield on physical footprints or separate investments without necessarily the restriction of physical footprint that sometimes you can have in the property world.
I think there's a question at the back.
What's that, sorry?
I think you had a question at the
Question?
yeah, at the back of the room. You going to questions yet, or?
We're still going
Maybe
through, I
can
think, aren't we?
come to some questions at the end, perhaps, rather than jumping back and forth. Here's a perhaps slightly controversial one for you, Josh. If I had 50 grand to invest, should I buy a 200 grand property or should I invest in crypto mining?
Well, the honest truth is all I can do is I can't predict the future, you know, so what the price of the coins are going to do this week, next week, 2 years' time, I don't know. Historically, they've increased year on year on year for the past 12 years. So last year, any of my clients that bought a single machine off us, which was £18,000 plus VAT, one machine generated £32,000 revenue. So with 50 grand, you could have made yourself quite a chunk. Now, that was a really good year for crypto, and it's not, you know, I'm not going to sit up here and say for a second that's what next year or the year after is going to hold. But all investments in property and kind of wider things, if you're looking at a 3 to 5 year financial play, you know, my company now, with the largest manufacturer of equipment, we've been doing it for 5 or 6 years, the clients that really made the money weren't the ones that got a nice number last year, but the people that did it the year before, and the year before, and the year before. And just the same way you have capital appreciation in the property market, you can access those same benefits in crypto, but with typically much larger numbers attached to them. So because I'm not saying buy some magical made-up coin that I've just come up with, we actually sell real, tangible, physical hardware products that do have retained asset value and you can get asset finance on. I did do that exactly, you know, so I grew the business quite large, and obviously now I make, you know, as well as selling the products and getting more people into it, I've taken up large chunks of my own money to have our own large mining facilities, and we've taken on quite a lot of investment to kick them off the ground. So it's a different thing, and the numbers can be much higher, but obviously, again, it's one of those things that we encourage people to do the research on and look at different options. So it's not a case of one being better than the other. You know, me having all my money in crypto would also be stupid, right? But it can offer a really nice side thing to other things that are going on as well. So
Stop being so diplomatic.
yeah,
You're supposed to say crypto.
yeah.
All right, one for Cam. What's likely to happen to finance in 2022?
So could you repeat that, please? Sorry.
What is likely to happen to finance in 2022?
Oh, finance. So 220. So time to bring the crystal ball out, and I'll put my neck on the line. By the way, wise people will always be telling you what you can't do. Hang around people who are doing what you want to do. Let me get to the point. So finance. So right now, my view on finance is, we're all aware, right? We have one of the lowest Bank of England base rates since the Bank of England started. It's the lowest that's ever been in my lifetime, probably your lifetime too. Who can remember the interest rates being 16.5%, 17%? Yeah, look around the room. Yeah, who can't even imagine rates being that? You young people. But they were, it's the truth. That's when I started back in 1989, I was 19 years old. Anyway, right now we have interest rates. The Bank of England base rate, of course, as we're all aware, is 0.5%. In real terms, residential rates for buy-to-lets and HMOs, etc., are hovering around the 3% mark. The number of deals that we're doing, we're finding they're around a good 3% mark. We have a different number of limited companies, we use these rates, 3%. However, if you're like me and you're quite analytical, and you like to check data, and you like proof, if you track this back to over 100 years, good sample of data by the way, 100 years, you will notice that the rates normalize around 6%. It's a fact. So if right now we've got rates around 3%, and they normalize usually around 6%, which I'll put my neck on the line and I believe that is where we're heading. Stay with me. Yeah? Do you agree that right now, just if we discuss the finance piece only, we are 50% discounted on anything that you buy in property? What do you reckon? Can we have a conversation, by the way? Do you agree or disagree? If you just look at the finance piece. right? Now, what is going to drive this? Yeah, what is going to drive this? So, if we look at right now, the LIBOR has now changed to SONIA. So the London Interbanking, whatever the OR stands for, rate. What does it stand for, Paul? The O?
I don't know.
Oh, who cares? Right, LIBOR, right? Benchmark. We are aware of the benchmark.
It's what
has
banks
been
lend to each
replaced,
other at.
Yeah.
by SONIA. So it's not who is SONIA. SONIA is the new benchmark. Not a lot of people are aware of this. So the sterling overnight indexed average is what it stands for, just in case you wondered. So SONIA is in place. Now, what is the big difference? The big difference is LIBOR. So what the lenders are pegging their rates to is anywhere around 0.5 to 0.7%. SONIA is hovering around 1.2 to 1.7%. Now, anybody here already, there's a lot of well-heeled people here, anybody here already investing, by the way? In property already, got mortgages? Now, you may or will be getting letters through the post actually notifying you of this, that the LIBOR rates are changing, and they're doing it very subtly under the radar. Not a lot of people are aware of this. So if the benchmark is changing and there is a new benchmark, the rates are higher on the new benchmark, so you're going to find rates going up. You know, forget about inflation, that's what we're going to add to it, etc. We're all aware of that. But SONIA is also going to be adding to it. No one's really talking about that. On top of that, when you look at what lenders are doing, lenders right now are making a big margin. Those margins are going to drop. The Bank of England, the rate is not sustainable. Two things that never are sustainable, you'll find, and you can track this back to over 100 years, is inflation and interest rates. Inflation is not 5.5%. We all know that in reality. It's not 7.2%. We discussed that earlier. It is much higher. They will try to, they meaning the government, the Bank of England, they will try to make sure there's a balance, but my view is they won't be able to hold it. So rates are going to rise much higher than you expect. My view is they are going to 6%. Not a lot of people are going to say that, but you know what? A year later, 2 years later, it all goes quiet. Last year, year before, when I was standing up and saying interest rates are going to rise, the wise people were saying, we're going to have negative interest rates. Where have those people gone now? They've all gone quiet. Are interest rates rising? Yes, they are. And trust me, over a period of years, my view is they're going to 6%. So the point is, very technical term, it's time to fill your boots as quick as you possibly can, because you do not want to be that person, do you, who says, I wish I could, or should, or would have.
Yeah, I think.
Because I've been that person in the past, I ain't going to be that person now.
I tend to agree with that in that, well, not that they'll go to 6%, I don't agree with that, but I agree that at the moment rates are very good. And even 5-year fixed rates are very good. You know, I just fixed a 75% buy-to-let mortgage for 3.1% for 5 years, which I don't think you can go too far wrong with that. I also just remortgaged my home for 1.7%. I mean, that's free money. As Cam said, if inflation's 7%, I'm making 5% on that money, which is great from a borrower's perspective. I think one thing to consider is obviously the Bank of England rate has gone up slightly recently, but when it dropped from half a percent to 0.1%, most buy-to-let lenders didn't pass that on. And when it's gone up, most didn't really pass that on either. Some did, but not many passed it on. So it's important to consider that the banks obviously have a margin. You know, if they're borrowing at 0.5% and they're charging you 3%, they're making 2.5%. And it's a very competitive market. So even if the base rate were to go up to 1% or 2%, that doesn't necessarily equate to a 1 or 2% rise in what it costs us. Because some banks will pass it on, others won't, and the ones that don't will be more competitive and more people will borrow from them. So, you know, I'm of the mind that you know, currently sitting around that sort of 3% borrowing rate, over the next 12 to 18 months, that'll probably increase to maybe 4%. I'd be surprised if it went to 6%. But keeping in mind, 6% is probably historical average. You know, so that's not bad either. So long as you're investing in properties that are appreciating in value and you've still got rents that are able to cover that cost of debt, then property is still a really good investment. It's going to eat into your net cash flow a little bit, but it depends what your goals are. You know, if you're looking to build a portfolio, the net cash flow is only a very small contributor toward your actual overall investment outcome. You know, it's more about capital growth. Obviously, whereas if you've already got a large portfolio and your main focus is income, then you need to change your strategy a little bit and focus on much higher yielding properties. I think we might have had a question over here, did we?
Yes, hello. From the previous lecture as well, which obviously some of you weren't in, one of the questions that was unanswered was why properties in central Birmingham have gone up a huge amount. And this title of this thing is called What Investment is Right for You in 22. I would put forward the proposition as to why that's happened is that because of all the legislation now that's against landlords, it's become very difficult for smaller landlords to make properties work because of, you know, difficulty to get rid of tenants, this, that, and the other. All the legislation coming in. I got rid of one property this year. Why? Because of the EPC thing. Because it was a leasehold flat, and I don't have control of the roof, and the roof was one of the things that was bringing the EPC down, so I sold. So I can see a lot of landlords getting out. So would you say that the price rises in central cities are being driven by big investors who can do much larger scale projects to renovate properties, and you know, landlords like myself and other people who have invested in the cities are getting driven out because of all the legislation? That's one thing. The other question I'm asked, because this is what the title is, What Investment is Right for You in 2022. I was wondering, talking to my gentleman sitting to my left, about bed and breakfasts working for social housing with the council. Because of all the, again, driven by the legislation that it makes it very difficult to get rid of tenants, and the councils can put on loads and loads of notices on you, which you have to spend a lot of time, effort and money to fight against on smaller properties. Is it right? Is it perhaps now becoming better to work with the councils and provide social housing, maybe bed and breakfast for people who've got evicted and things like that? Okay. So that's my second question.
Okay, two very different questions. Well, let's start with Birmingham. In my opinion, the reason central Birmingham, Manchester, Liverpool, you know, the other major cities outside of London have done really well is firstly because of Section 24, which has hit high value, low yield properties and caused a shift of the majority of investors who used to invest in London and the South East to look elsewhere for higher yields. Secondly, city centres provide more utility. You know, jobs, facilities, amenities, infrastructure, bars, restaurants, gyms, cafes. The reasons people live in a location are abundant in city centres. I'm very, very familiar with those three cities, and we first started investing there about 8 years ago, and prices have more than doubled since then. Sort of answering the question of where I would say is a good place to invest now isn't necessarily B1 or M1, you're right in the centre, because I can't see that happening again over the next 5 to 10 years in those areas, but you can go half a mile in the right direction, and I can see it happening there.
The ripple effect.
The ripple effect, obviously.
No, the main cities are desirable, and you can't build no more there. The land's not there, so that's pushed the price up. But the next step is just outside them city centres, where people will still want to live, for the reason being there's good access links straight into the cities. And that's what we specialise in, and that's what we do at HJ Collection.
Yeah.
Yeah.
You're right, the focus has definitely shifted
changed,
toward modern properties.
Correct.
Yeah,
so
but I don't
depends what
necessarily
your
think that's
structure is.
solely driven by large investors. You know, we as a company have, our clients have probably invested in a few thousand properties in each of those cities over the past few years, and it is mostly new builds, because that's where the demand is. You know, you're looking at young professionals that want nice new places with all the bells and whistles that comes along with that. So there has definitely been a shift toward that type of property.
Well, if I may jump in there. So it's also about being tactical. Now, we're all facing the same challenges, but how can you become tactical? So, for example, what we're doing is we're investing in commercial in these types of areas. And quite right, I agree with Reece, it's not about the prime. You don't need to be investing in the prime part of the centre. It's about the satellite areas around that. So we invest in commercials, in secondary parades and tertiary parades. They're working really well. We call these commercial buy-to-lets, shops and uppers. Properties that are sitting there empty, you can really bring back into and repurpose back into accommodation. So we've got, we've got 4 of these projects going on in north of Watford, and we've got a couple of them working in London. So in Eltham, we've got 2 single stories, 87 to 89 Eltham, High Street. By the way, I'll be doing a few more seminars, I'll be showing you these examples. Feel free to come along if you wish to, yeah? There, it's a single story, and what we're doing is we're getting planning gain to build above that. That's a £3.1 million project. In the north, we're doing things like commercial units with flats above, which are already converted. And we're making sure that the costings on the flat are paying for the whole unit. So the extra discount becomes the commercial unit. Hope I'm making sense here. And these are easy entry-level projects that anyone can jump into. You know, 110K, 120K, 150K, very doable when it comes to property. So it's about becoming tactical what you're doing. Hope I'm making some sense there.
Well, I think if, as someone who's on the stage, I don't own any properties. And all of this sounds bloody complicated to me. I don't have any customers, I don't have any red tape, I don't have any red letters, I don't have any government, I don't have any councils, I don't have any tenants. I plug in a computer and I turn it on. And I'm earning money as I'm sat here. So
that's it.
That's what I do. So ultimately, I don't need governments, I don't need investment, I don't need red tape, I don't need letters, I don't need PPCs, I don't need my roof falling off. I don't need any of that. I just have a plug socket and an internet connection, and that's worked. So 70% of my clients are high net worth property investors that are moving away from the sector because this. So I'm not saying, property is a great thing, and I'm not here to boo-hoo it, but it's getting harder and harder and harder and harder. And ultimately, digital assets have the highest yield asset growth of anything on the planet, and that's where I'm putting my money.
Yeah. I think we need to keep in mind that past performance isn't necessarily a predictor.
Absolutely, yes. That's fair.
My portfolio is down a fair bit over the past few months.
Yeah.
But look, property can be quite passive as well. I think that's important to keep in mind. Obviously there's lots of landlords in the room, and I don't mean to offend anyone, but landlords love to whinge. And it's all about, the council's done this now, and this new rule, and life's just too hard for me. Well, actually, you can't, if you're investing in the right properties, in the right areas, that are quite passive, and especially working with a company that can help you do that, is, it doesn't have to be difficult. We've got clients all around the world that have never even been to the UK, and their investments perform just as well as clients that live around the corner from their properties. So, I think we shouldn't get bogged down in what's too difficult, because considering what may be difficult, property can still be a great investment.
So true, and what I'd say is it's about upskilling yourself. And it's quite difficult because you've got to change your mindset, haven't you? You've got to look at the half glass full as well as the half glass empty. But you can upskill, and the people that choose to upskill take themselves from being self-employed, which really is a very, very well-paid job, isn't it, when you think about it, to becoming business owners, to becoming business people, where you are not just self-employed, you're a business owner. The key difference is, what I've noticed there, is that you have your own time back. Because why are you actually doing this? Surely you're doing it to improve your lifestyle, your people that you care about, all that kind of stuff, right? To maximize on your income. Yeah? So, and it's quite difficult for people not to do it, and it's quite easy for people to actually do it. In fact, we have a system called the bar system. I won't go into it right now, because I won't go on, but it's a bar system where we make every single property with none of your money left in it. If you've got a property with none of your money left in it, and you can do it practically, it's a bar system, I'll share that later on over the seminars, you have something that's producing income for you, and work out the result, you will find an infinite return on that. That is very doable. We do this. We do so many projects like this, and you can do this if you're not already doing it. Next day, 6 to 12 months, 24 months, and 36 to 48 months. Within these time periods, you can have a no money in deal, very doable. If you've got that, what do you really care if the prices are going up or going down? You've created a cash dispenser throwing money at you. And the return is infinite. Hope I'm making some sense here for you.
It's important to clarify that you're not
you can
talking
choose
about
to adapt.
no money down deals.
Yeah. My view is there is no such thing as no money down, because you always need money.
Yeah.
But it doesn't need to have to be your money necessarily.
There's another question
Another
here.
question. I think we'll give someone else a turn. If you don't mind, we'll just give someone else a turn.
Hi there. I would like to say on crypto, it's just as difficult as property. If you look at the rates, if you're investing at the moment, crypto actually is plateauing. So you don't know, so it's speculative. I would say with property again is speculative. And it's an age thing. A youngster trying to get into property now, I would say would be very difficult, although a lot of them are looking at it. Look at the ages. The portfolio people, like myself, right, are at a certain age. Yes, when I go up to the north, they are getting out. There are some young people getting in. It is getting more difficult. I like to give them encouragement, but when you're talking about 25% return that you've got to put down for a lot of young people, that's quite difficult to get, given all the expenses.
So I mean,
show me a way out.
I can happily pick up on those points. So with crypto, obviously, your comments at the moment about it being plateauing, I mean, that's a perfectly reasonable comment. The market's been quite sideways for the last 6 months. You know, we peaked at $69,000 Bitcoin last November, and now we're about $40,000 Bitcoin. So we're down about 50% in the last 6 months, which sounds terrible until you zoom out and look at the last 3 years, and we're actually up 1,200%. So it's on a 3 to 5 year, 10-year window. That yes, you have volatility, but it's volatility in a single direction. And when it comes to ages, the average age of my clients is 58. So it's actually people in more so this demographic that are looking at alternatives as things move forward. So everything carries risk and everything's different, but again, it's just a way of kind of mitigating some of these more slightly difficult circumstantial things you can't care about. You know, everyone here is getting upset about interest rates going up 1 or 2%. I'm not bothered. The machines make 5, 6, 7% a month. 1%, 2% doesn't interest me. But given, you know, you've got to look at, as with property, no one's doing this to make the money back in 12 months, 2 years, 3 years. It's a multi-year play for a longer period of time. And with those things in mind, digital assets sit really nicely aside traditional assets that these guys all do really well as well.
Would you like to come up on the stage, mate? Sorry? Yeah, we'll go with the question, yeah. So, Reece, I know you do a lot of permitted development rights stuff, developing in, as you say, second and third tier cities. Would you like to talk a bit more about that and, you know, what's happening in that space at the moment?
Yeah, I mean, Cam touched on it briefly, but there's so many opportunities with the pandemic that we've just come out of, with office space that are vacant in city centres that are not Birmingham, Manchester, Leeds, but the likes of, you know, Bolton, Wakefield, Pontefract, Doncaster. We convert them into residential, and, you know, again, the same as what Josh was saying, my company is in the property sector, and it can take all of your headaches away from yourself. Investors can not be a landlord, they can be a lender and lend us your money for a fixed coupon payment back with fixed security over our assets. For us to be able to convert office space into residential, which eliminates all of the problems that everyone here has been talking about, and we can explain how we do that in more detail. I've got a seminar later on. This is not about us telling you what we do, but giving you some advice. But if you want some more information, what we do, feel free to speak to me after or come to our stand. But them areas are very buoyant for us. You know, we rent all of our developments out, so we retain all of our developments. We use investors like yourself to lend us money to purchase acquire and develop and then retain them assets. Pretty simple. And we only specialise really up north because, you know, the yields are there and there's abundant of people that need new homes in and around them areas. And it's as simple as that. We keep it very simple. We stick to what we know. And that's what I think investors should be doing. You know, you need to be doing your research, stick to an area that you believe in and you can see that's buoyant, and it will work for yourself. Yeah, comes with headaches, but what doesn't? You know, as long as you've got the asset, it's a great investment.
Cool. Josh, you kind of touched on this before, but what's the typical annual returns you can expect from crypto mining?
So in terms of typical returns, it would be completely inappropriate for me to stand here and say anything in crypto is typical. It's exceptionally volatile. It's just that historically it's been volatile in a single trajectory direction. So, you know, in 2017, Bitcoin first hit $20,000 and everyone got quite excited about it. You know, then it went down to $3,000 and then bubbled away for a few years. Obviously, this last year it went up to $69,000 and now, you know, it's kind of come back down to around 40. So again, in a 3-year period, you've had 1,000% return on your investment if you're in the market at that time period. But what a lot of people don't realize is just what cryptocurrency and Bitcoin and blockchain is all about. You know, only a few months ago, Bitcoin as a global currency was worth more than the pound sterling. But yet, people still think crypto's this weird little thing that's going to go away. You know, I advised the EU Parliament about every nation state on Earth that's soon going to be creating its own types of central government-backed blockchain crypto projects. We're going to have a crypto pound and a crypto dollar and a crypto euro. You know, this is where things are moving to. So ultimately, in terms of typical returns, it's, you know, it's how long is a piece of string. The beauty of what we do in terms of my business is that rather than saying, hey, buy this coin, it's going to go up in value, you're kind of exposed to the market, whereas my machines are effectively the hardware underlayer that move all the coins around. The same way you have an internet server that keeps a website running. My machines keep the whole blockchain system running. So by buying a physical computer, then you've got all the tax advantages and the more traditional kind of asset value of equipment. You can kind of enter the digital space in a physical manner, which is a bit more digestible. But historically speaking, you know, last year was around 120% return if you kept the you know, Ethereum for 12 months. But of course, any client will have a different return because it totally depends upon when they choose to sell the coin. Most of my clients will have kept those coins probably for 2, 3, 4, 5 years plus. So people that were involved in this, you know, I can see a few clients in the room already that have been doing this for a few years. You know, their return will be very different. So it's you know, a longer term play. But that said, you know, even if you were selling the coins at the end of every month today, when the markets come down a bit, you'd be experiencing kind of 6 to 8% return per month. As things stand currently, but obviously that can change quite quickly.
Excellent. Okay. Do we have any other questions for the panel? Actually, just one thing. One of my colleagues handed out a feedback form to everyone. We're running a competition at the show today where we'll be drawing a name from a hat and giving away an iPad. So by filling in that form and returning it to us, you'll enter that draw. And aside from that, hopefully, you know, we might be able to help some of you with some of the things we've been talking about. But any questions from the crowd at all? We got a microphone? Microphone, guys? No?
Dom. I think.
Yeah.
Is that working?
Hi, thank you.
We can hear you now.
Yeah, so it is. So it seems a little bit easier to put a few £1,000s in crypto, and which I did a couple of years ago, and it did generate me quite good profit. So I do understand this. However, it seems a little bit more difficult to gather £50,000 and then put into that into a property. So I do understand that, and I also see the benefit why it can be worth to put your money into crypto. But what about the risks? So for example, we were talking about because of the war and the energy prices are going up, and I think understand how this affects the property market. But how does it affect the crypto market? Because I do understand that you don't have tenants and mortgages and these things. However, what you have as a cost is the energy, because you do need a lot of electricity to actually mine the coins.
Yep.
So how does this affect potentially the crypto market? So the energy prices are going up. This is one risk, potential risk. The second one, you mentioned the European Parliament. So the politicians and governments are talking about regulating crypto and cryptocurrency in the crypto market. So I'm not quite sure how much they can, because the whole crypto market is about decentralizing, right? Decentralization. But if the government start to regulate this and the trading, then so how does this affect us, crypto traders or crypto investors? This is the second thing. And in relation to the war again, we know that there are huge mining pools in, for example, China and that part of the world. So if the war will go on, how will that potentially affect the mining pools? So if China or other governments will just completely shut down these pools, then we will see a big drop in the crypto space. So yeah, so what can you tell us about the risks? Thank you.
Okay, well, 1,000 questions there, but I'll rattle through it very quickly. So firstly, in terms of electric cost, yes, the machines use electric to run. You're completely correct. But of the £32,000 that a machine generated last year, £2,000 of that was your electric cost. So given that, say that's doubled at the moment, electric's gone up a lot. Well, that was £4,000, so maybe 10% of aggregated costs. Fine, I'm happy to take that. In terms of what's happening with the regulation, actually, regulation in this market is going to be a brilliant thing. A lot of people are very scared of crypto getting regulated, but actually, there's many people in this room that probably think Bitcoin is this dark, underwood, seedy, nasty, terrible thing. And actually, I think regulation will bring a lot of clarity to that. So, we have people like Elon Musk. Tesla's already bought $1 billion of crypto. MicroStrategy owns $5 billion of assets. Grayscale is the largest hedge fund that has Bitcoin at the moment at $30 billion. So, looking at the war, the Ukrainian government released a Bitcoin wallet and an Ethereum wallet to circumnavigate international pressures to be able to help pay the troops. So we've now got El Salvador and Ukraine as two nation states that are now accepted crypto as a native payment for the country, and it's only a matter of time before more nation states continue to accept the technology. So moving forward, when we have a digital dollar and a digital pound, it's going to be very difficult for a nation to release their own cryptocurrency, whilst at the same time complaining about Bitcoin and Ethereum and the existing ecosystem. So the two things together will sit alongside each other, I believe. And ultimately, digital assets will continue to be more well-defined, which will create clarity, which should obviously help the sector grow over time. So all in all, I feel quite confident about the future, given if things are a bit uncertain at the moment.
What do the other three panelists think about crypto, or have either three of you, have you invested in crypto?
Yeah, I'll start. I've invested quite heavily in crypto. I resisted it for quite a while because I thought it might fade away, and that didn't happen. So, I think it's the future. I agree with Josh. So we're going to definitely move toward digital currencies as a whole, and governments will release their own cryptocurrencies. But what people like about Bitcoin and Ethereum is it's decentralized. So it's not controlled by a government. You've only got to look at how governments manipulate the supply of money, and how, £10 in your pocket isn't worth £10 in your pocket anymore because they keep printing more £10. That doesn't happen with Bitcoin. So it definitely, whether it be Bitcoin itself or a version of it, it definitely is going to be a big part of the future. And I suppose the only thing I would say is my financial situation is quite different to your average person, and I can afford to invest money where I may not get it back. And I think you need to keep that in mind, that investing in crypto, and especially the smaller coins and things, it might go to nothing. Or it could do really, really well. So that would be my advice. Don't put too much into it unless you can afford to.
Yeah, I'll go second. The same, if you're going to invest in crypto or an asset similar to that. You've got to be prepared for the worst case scenario, in my opinion. Have I invested in it? No. The reason being is because I stick to what I know, and that's property. I do diversify in some things. I haven't diversified in the crypto market. Now, that's not to say that it's a bad investment, but it's just not one for me at the moment.
My view is only invest in what you know about, what you learn about. So it's quite easy to actually make money. If you haven't made it yet, you might think that's difficult. I used to think that. But once you've made it, actually, a number of you here who have made that, retaining it is very important. So my view is only invest in, and I will only share with my students and so on what we are doing actively so we can give you specifics. If you want to learn crypto properly. If you want to learn property properly. And it ain't difficult. Yeah? By the way, would you like some really good interest rates? Is that all right, Paul, for sure? Would you like some really good interest rates to add some value here? Yeah? Current products, who'd like that? Who doesn't? Who does? All right. Shall I?
Sorry.
Some really good interest rate products that are out there right now. I'm not an FCA regulated mortgage broker, but these are products that we are taking on, so I can share them with you. So, number one is fleet mortgages. Fleet mortgages right now, very exciting. We've just got products from them just in the last 6 weeks. 4 properties, 2.99%, 5-year fixed rate. And they're going up to £5 million in terms of how much you can buy. Really good rates. Just been taken over by Starling Bank. And on the head of Starling Bank is Anne Botton, a woman with a lot of, some serious business sense. And she's bringing that all the way to fleet mortgages. So fleet mortgages are really good right now. Active investors. Second one is Vida Home Loans. Vida or Vida. Vida Home Loans. We love Vida Home Loans because you can be 18 years old. You can be up to 80 years old. You can get a mortgage. You do not need to be a homeowner. So my daughter, for example, she's a teacher. She's created her own company. She's one of my mentees from, obviously, when she was little. So what she's doing is she's investing, and she's used Vida Home Loans because she lives at home. So that's a great way that you could use Vida Home Loans. Works really well. They will also go down to the values of £50,000 because that can be a challenge in places north of Watford. So Vida Home Loans were, I like them. By the way, no FCA regulations. I'm just sharing with you products that we are taking on. Would you like one more? One more?
I am an FCA regulated mortgage broker, and I'd strongly recommend that rather than approaching lenders directly, speak with an independent broker. Because
100%, absolutely.
you can waste a lot of time trying to deal directly with lenders, and you may not fit their criteria, and then you go to the next one, and the next one, and the next one. Whereas, more than half of the buy-to-let products in the market today are only available through intermediaries.
Absolutely
Not
correct.
only do you waste time approaching them directly, but you also only have access to less than half the products. So,
You definitely need a good mortgage broker for sure, but these are products that you can get from intermediaries like good mortgage brokers. And obviously Paul's one of them. Third one, quickly for developers, is Alica Bank. Alica will allow you to actually get, so for example, we do commercial properties. They'll actually allow you on a tenancy agreement to look at a higher value and assess it on a higher value, whereas you're buying the property at a lower purchase price. So they're allowing you to capital raise right from the purchase price point. Just to add a bit in.
Thanks, Kim. I think we're pretty much out of time now. We might have time for a couple of questions if anyone's got any. Just a reminder on those feedback forms to enter the draw to win the iPad. And I'd say hopefully we might be able to add some value to your situation. Another question over here.
Hi guys, short and sweet, what is your minimum investment levels and what do you charge for it?
Good question.
Minimum investment levels. What was the second part, sorry?
What do you charge?
Oh yeah, okay, good question.
Please. So I'll start. Our minimum investment level is £10,000. You get a fixed coupon payment back over a fixed time frame, and the security for investor would be a debenture or a first charge over our company assets, which we can go through in more detail. And the second question, fees. There's no fees for investing with us. We take care of all of the fees for you. So if you invest, let's say £100,000, your £100,000 is what you would get back plus your interest on that £100,000.
When it comes to our equipment in the crypto world, the machines that we've got on the stand over there, you can see they're 18,000 plus VAT each. Most people put them through UK Limited, get capital investment allowance. Some people use them for R&D. But basically, a single machine's 18 grand. You can buy as many as you want. Obviously, the price scales over time. We don't take any fees, any commissions, any cuts. It's your equipment, and you earn 100% of the revenue, and then let the market do its thing. So nice and simple.
As a property investor developer, I train people to do the same thing that we do. So investment levels can start from, for buy-to-lets, from £40,000, and they can range into HMOs, where we're looking at 120 to 150,000, and they can go into commercials, where projects of 3.1 million to around 4.5 million, where we are. So we're small developers up to that level. Leverage, you're looking at typically 75% for the first two models I mentioned. And for the commercial, you're looking at typically 70% loan to values. Every single deal that we do, and I train people on this, is no money in at some given point. So you have none of your capital expenditure, so your return is always infinite at some given point.
Okay, and finish up on that question. Look, the minimum for us is kind of determined by the market. You know, we like sort of centrally located properties in reasonable sized cities. So I'd say there's not really much worth buying in the UK under about 100 grand, maybe even slightly higher than that. So, if you're looking at a 75% mortgage, that's about 30 grand minimum to pick up a half decent property. Closer to 50, you're getting a much better property. And what we charge, we try to make it mutually beneficial. So if we source a property, generally we can collect a fee from the vendor. Anyone will pay us a fee for delivering a buyer and facilitating a sale. We can do the mortgage for clients, we can do the management for them, and obviously there's fees for us there. So we try to make it very much a mutually beneficial relationship. Great, well I think we're out of time now, guys. Thank you very much for your time.
Thank you.
Please do come over and have a chat with all of us on our stands. We're all doing our own seminars throughout the day as well, so check out the schedule and come and have a chat. Thanks very much.
Cheers, guys. Thank you.
Thank you.